Yeah, I'm assuming everyone can hear me. I'm going to start the seminar right now. If you have any questions, I think you can put them in the chat box or raise your hand, and I'll see if I can take your call. So let me start with this seminar. Again, my name is Mike Solomon. The seminar is put on by the law firm of Solomon, Steiner Peck, and we're going to talk about what some people call Secure Act 2.0. It's made significant changes to the tax law dealing with retirement accounts. Let me move my phone away here so I don't take a phone call. And I'll try to follow along the outline the best I can. Before I start, though, excuse me 1 second. Before I start, I wanted to give an overview of what the law existed right up to this new change of the law. And then I'll go through my outline. So, as you may remember, the Secure Act, which was passed effective in 2020, changed the required minimum distribution date from 70.5 to age 72. And this new act, as I'll go into it, extends that even further. And the rules under the Secure Act of that passed a couple years ago changed all the distribution rates for IRAs and 401ks. It used to be that when you bequeathed your IRA to children or grandchildren, they could take that IRA over their life expectancy. The new rules have shrunk those rules completely. So on your passing, your IRA or 401k, if it goes to a spouse, that spouse has a lot of options, including rolling the money over into his or her own IRA and starting at that point to treat it as their own account. If it went to children or grandchildren now, unless it's a child under age 21, if it's to a child over age 21, it now has to pay out in 10 years. So that's changed the rule significantly. There are only certain exceptions to that rule. An IRA paying to a spouse can pay out, as I say, over the life expectancy of the surviving spouse, or the surviving spouse can roll it over. That's always been the rule. If it goes to a individual who's within 10 years of your age, they can still take it out over their life expectancy. So, for example, if your IRA is going to a brother or sister who's within 10 years of your age, they do not have to liquidate it within 10 years. They can take it out over their life expectancy. And if it goes to certain disabled children, special needs people, they can also, in many situations, stretch the payments out over their life expectancy. Or if it's going to a minor child, not a grandchild, but your child who's under age 21, then they can take it out over their life expectancy until they hit age 21, and then they have to empty it out within 10 years. So those are the basic rules. If it goes to a charity or certain other people who are not eligible at all, it may have to pay out as quickly as 5 years, depending on what happens. So that's the basic rules. Now, let me continue on, and I'm going to go through my outline now. So this law was passed in December of last year, and it has a lot of different changes that are going to impact both businesses and individuals. So let's talk about traditional IRA and retirement plan distributions and how it impacts all of those. Now, beginning this year and through 2032, they've raised the age for the required minimum distributions to age 73. Now, as a practical matter, this is only going to hit people next year. If you turn 73 in 2024, you can. So if you turn 72 this year, you don't have to take out a minimum distribution. You can wait till next year and take out your minimum distribution in 2024. So that impacts many, many people, not a lot, but a number of people who happen to be turning 72. So the magic age is if you were born from 1951 through 59, your required minimum distribution date is age 73. So the earliest that would be is next year. Then in 2033, so this is for a lot of people who probably aren't attending the seminar right now, but could be, your required minimum distribution date will be 75. And those are for people born in 1960 or later. So this is basically delaying when you can take out your IRAs, which is a benefit for a number of people who want to hold off as long as possible, excuse me, taking out their required minimum distribution. Now, if you happen to be working for somebody past this age, and you own less than 5% of the business, so you're working for a third party, an employer, or you own a small portion of the employer, your IRMD does not begin from a 401k plan, let's say, until you actually quit. So on the year that you turn 73 right now, if you're working for somebody and you don't own 5% or more of the business, then you can delay receiving your required minimum distribution until you quit. Now, this only applies to the 401k. If you have an IRA, you still have to start taking out your required minimum distribution. That's always been the law. And the magic period is the year you turn 73. So if you're doing some planning, let's say you're working for a business you're a part owner in, and you want to delay your distribution, if it made sense, try to get below 5% ownership prior to the year you turn 73, and you can delay taking your distribution. If anyone has any questions, please try to raise your hands or try to text the message, and let me see if I can see it. So now, effective next year, the surviving spouse gets a little bit of more of a benefit. Let me explain this. You can read this more at your leisure, but here's how the rules worked up through this year, actually. So if you pass away and you're survived by a spouse, your surviving spouse has many options. Number one, and the typical one that happens, is the surviving spouse will take your IRA or 401k, put it into her IRA. Let me just assume it's a wife for a moment. And then she will then be her IRA governed by her rules. So if she's under age 73, let's say, she could hold off taking any distributions. If she's over age 73, she'll start taking out required minimum distributions and we'll be using a better table. It's called the uniform table. And what that table does, for example, if your husband passes away, wife rolls it over to her own IRA. Let's say she's now 73 or 74. She goes to this uniform table and it determines her required minimum distribution, but it's based on the assumption that it's her age and a beneficiary, a contingent beneficiary of her, someone who's 10 years younger. So for someone who's like 73 or 74, according to the tables, their life expectancy is like 25 or 26 years. So but if they, under the existing law, that will change next year, but under the existing law, the spouse also has the right to say, I don't want to roll this amount over to my account. I want to treat it as my husband's IRA, and I'm just the beneficiary. That might be done where the situation where the spouse that died first was a lot younger. And you wanted to delay taking distributions. So let's say the wife survives, she's 73 and her husband was 60 years old. She might say, I don't want to start taking distributions out now. I'm going to treat this IRA or 401k as if it were my husband's, and I'm a beneficiary of it, but it's still his. And I'm going to be able to delay taking distributions until he would have hit his required minimum distribution date. So that could be another 13 years in my example. Now, the downside is that then when the surviving spouse started taking out required minimum distributions, she had to use a different table. It was a single life table, much faster. It's almost half the payout rate in age, excuse me. So it's almost double the payout rate. So there was a consequence to it. The new rules that kick in 2024 say now the surviving spouse, after she decides to start taking it out from her younger deceased husband's IRA or 401k, she can still use the uniform table. The bottom line is there's a lot of planning to be done when a spouse passes away. There are a lot of different options that can be done. Even this one example, you could wait the 13 years, for example, after the husband died at age 60, you're 73. You wait the 13 years, and then you roll over your husband's IRA into your own account. So you've let it accumulate for 13 years. So Congress addressed that a little bit, or the IRS addressed it, I should say, and they're going to make you catch up with all those required minimum distributions if you do that. But there's still a lot of planning. The typical planning, again, is you roll it over to the surviving spouse, but it's not always that. There are other options that you definitely want to think about before you take the actions. Let me go on. Now, another tool. Now, I'm not 100% sure why all these staggered dates. Some of them I understand. What Congress did was they delayed, as I mentioned earlier, the day you have to start taking out your required minimum distributions. That reduces income tax revenue. So they got to raise it somewhere. So many of these changes are done to raise revenue, but I'm not sure why this was pushed out to 2026. But beginning in 2026, you can take out a certain amount of your 401k without to pay long-term care premiums without being subject to the 10% penalty for an early distribution. Now, this is a very small population of people this is relevant to, because the penalty for taking money out early starts at age 59 and a half. Most people aren't really buying long-term care insurance that early, but if they do, they can now take out a small portion of their 401k plan, take it out. They'll pay income taxes on it, but they won't pay the 10% penalty. So that's just a little bit of planning, but it's a few years in the future. Now, a big change deals with annuities. So let me explain how this works. Many people want to take advantage of a provision in the tax code that is very rarely used, and that's what's called, and again, you can read this. I'm going to summarize all this paragraph here because it's going to be hard to follow. There's a provision that was passed a number of years ago that allowed IRAs, for example, to buy what are called qualifying longevity annuity contracts. What that meant was you would take your IRA and you would buy, in that IRA, let's say you had $500,000, and you were coming up to your age where you had to take out a required minimum distribution. Congress wanted to encourage people to stretch out their IRAs as long as possible so they had money for retirement. So what they said was you could buy in your IRA a qualified longevity annuity contract. I mean, an annuity contract that didn't start paying out until, let's say, your mid-80s. The idea would be is that you would start taking out at that time at age 70 and a half. Now it's 73. You would start taking out your required minimum distributions, but you would have this annuity coming in, started kicking a decade or so down the road when you're in your 80s, for example, that would then give you more payments, so you would have more money for your retirement. It would give you some assurance that there would be some money left. So, but the provisions they put in the old law, which is still now, but modified, still in the existing law, but modified now. Under the old law, they said that annuity that you bought that would not count when you calculated your required minimum distribution. So if you had a $500,000 account and you bought a $100,000 qualified longevity annuity, you would only have to pretend that you had $400,000 for purposes of the calculating your required minimum distribution. So you're letting that annuity grow tax deferred for another decade before you start dipping into it. The new law expands that. So what they've done is they've raised the dollar limit. They got rid of this. There used to be a 25% cap on how much you could use for a qualified longevity annuity. They got rid of that, and they increased the amount from $145,000 to $200,000. So you could buy up to a $200,000 qualifying longevity annuity contract, put it in your IRA, have it, let's say, not start making payments until I'm making up an age, but I think it's mid-80s. And you don't count that $200,000 when you start calculating your required minimum distribution. So it's a benefit for people that are trying to do long-term planning. Now, in addition, what they've added, they allow these IRAs now to buy guaranteed annuity contracts with annual increases, a return on premium death benefit, and certain guarantees, which weren't allowed in IRAs prior to this, or it was problematic. So now they've allowed that. And so that adds more flexibility for annuities inside of IRAs, if it makes sense for you. Now, for many people, it doesn't make sense. Remember, one of the benefits of an annuity is it's income tax deferred, but you're already income tax deferred with an IRA. So I think for many people, that may be a benefit if they just want to secure their investment. Annuities can give you that sort of certainty that you won't necessarily get with the stock market. So that's one of the advantages. And a longevity annuity might be valuable for people. It's not a major part of your IRA. If you have $1 million IRA, you're going to be capped at $200,000, for example, and that's adjusted for inflation. But it does give you some more flexibility. You should definitely look at this as you approach or even have passed your required minimum distribution date. So that's on annuities. Any questions on that? Okay. So let me continue on. Now, this is a big one we have, or I should say, happens from time to time. Many people mess up when they're supposed to take the required minimum distribution. They either make a mistake on the mathematics, or they forget. They forgot they're supposed to do it. The penalty is pretty significant. The penalty is 50% of the amount that you should have taken out. So beginning this year, Congress reduced the penalty from 50% to 25%, first of all. So for example, if you were supposed to take out $20,000 and you forgot, it used to be a 50% would be a $10,000 penalty. Now they've reduced it to 25%. But even more, you could reduce the penalty down to 10% if you report your error to the IRS before they've issued you a tax notice that, hey, you made a mistake, or by no later than the second year after the tax is imposed. So let me explain in English. So I'll give you an example. Let's say you forgot to do your minimum distribution in 2023. That tax is due as of January 1 of 2024. You owe that money. You should have filed a return that said, hey, IRS, I forgot to take my minimum distribution of $10,000. Here's a check for $2,500, and you owe that tax beginning January 1 of 2024. Now you have until the 2 years, the end of 2025 in this example. So you forgot to do 2023's required minimum distribution. You should have paid it on January 1 of 2024, file the return, I should say. They're going to give you 2 years, all of 24 and all of 25, to tell the IRS, hey, I made a mistake. Let me off the hook. Here, I'll pay 10%. Now, in addition, you can always try to get that waived. You can write the IRS and say, hey, you know what, I forgot, forgive me. There was an illness in the family. Someone messed up. I had relied on my attorney, my accountant, my advisor to do this, and they didn't, whatever. You might get it waived. But here, at least, the penalty has been reduced. Even more important, they changed the statute of limitations. It used to be, excuse me again, the statute of limitations did not begin to run until you filed the tax return, not the 1040, but a special tax return when you owe a penalty. Well, no one ever filed that. So that meant the statute of limitations never ran. And that meant in some situations, the IRS could go literally back decades. And then, if they go back decades, not only you owe the tax, you owe penalties on that penalties, you owe interest on the penalties, could add up to quite a lot. Now they said, look, when you file your 1040, that's when the statute of limitations begins. So it's a 3-year statute. So the changes are as follows. They've reduced the penalty significantly. If you make a math mistake, you can get the penalty automatically reduced as low as 10% if you file within 2 years. And they finally said the statute of limitations runs after 3 years. So it kind of, gets this burden over people that, I made a mistake and this is going to haunt me for the rest of my life because, I'm concerned about it. Any questions on that? Okay, let me move on. Beginning next year, they've codified. This actually happened during the beginning of the COVID crisis, where they have these special rules for emergency withdrawals. Now they've made this somewhat permanent. You can draw up to $1,000 from your IRA or 401k for a unforeseeable family emergency. That doesn't mean college tuition, by the way. That's foreseeable, but something unforeseeable. You won't incur this 10% penalty again, and you have 3 years to put the money back. So it allows you to take a small amount out, pay some bill that you had to pay that you didn't know was going to happen, not have that penalty, and then put the money back and let the money grow tax deferred. So again, it's another benefit that someone can have. Okay, now charitable gifts. They have not changed the date that you can use this provision. When you turn 70.5, you can contribute up to $100,000 directly from your IRA to a charity if you're charitably inclined. It doesn't save you any federal taxes per se. If you're greedy, and I don't mean that in a derogatory sense, I mean you're never ahead giving money to charity. So if you said I want the $100,000, I've got a deduction, that's great. You don't pay income tax on the $100,000. But if you just took the $100,000, even if you're giving the government 30 to 40%, you still have $60,000 in your pocket. So, however, if you're charitably inclined, this is a great way to give to charity because if you send the money directly from the IRA to the charity, let's use 100,000. From a federal point of view, if you itemize, you still might be phasing out some of your itemized deductions, and it also, by taking that 100,000 in income and then deducting it, you lose some other benefits. That number one, your income goes up, your Medicare payments may go up next, within the year when the IRS sees this gigantic chunk of income coming in. So it's a way to avoid doing anything strange to your income tax return, and you still get effectively a deduction for the 100,000 because you're not including it in income. In addition, if you're an Ohio resident, there's no Ohio charitable deduction. So if you take $100,000 from your IRA, put it in your pocket, and then write a check to the charity, you'll still get your federal charitable deduction, but you'll pay Ohio income taxes on it. So by having the money go directly to the charity from your IRA, you're saving Ohio income taxes, you're possibly saving some federal income taxes because you don't have some of the phase outs for high income, and you're not raising your Medicare premium payments as much as might happen if you include that 100,000. Now, what they have done also, they've adjusted it for inflation. So this 100,000 has been a set number for many, many years. So they're now going to have it adjusted for inflation. Finally, they're allowing these. This is not a big factor, but you can have $50,000 go to a charitable remainder trust or a charitable gift annuity. Now, what that is that, let's say you Red Cross, for example, they might have a charitable remainder trust set up or a charitable gift annuity. You give them 100,000 for a gift annuity, and the Red Cross promises to pay you, $500 a month for the rest of your life, something like that. So you get an upfront charitable deduction based upon your life expectancy and the rates of returns they assume and the amount of payments you're getting. So let's say, based on your life expectancy, if you put $50,000 in a Red Cross charitable annuity and they're promising you $6,000 a year, the present value of $6,000 a year for the rest of your life, I'm going to make this number up completely. Let's say it's $30,000. Then you're going to get a charitable income tax deduction up front for 20. You gave 50 away. You have a present value of these $6,000 a year that you're going to get for your life is worth $30,000 according to the IRS tables, and you get an income tax deduction of $20,000. So it gives you a little stream of income, and also allows you to give something to charity. So it serves two purposes. It's a fairly small amount, but it's an amount that people can do. Any questions on any of that? Okay. Let me move on. So there's some new rules impacting Roths. So beginning next year, the Roth accounts that you might have in your 401k or 403b or 457 plan will have the same rules as an individual Roth. Now, what that means is up till through this year, if you hit your required minimum distribution date, even though you had a Roth inside your 401k, you had to start taking money out of your 401k. Or if it's in your individual name, you didn't have to take out a Roth, your Roth contributions, because as you know, Roth accounts do not require an individual Roth account. An IRA Roth IRA, does not have required minimum distributions. You can keep that in there for the rest of your life. But up till recently, if you had it in a 401k, when you turned the appropriate age, let's say 73 now, you had to start taking it out of your 401k, even though it was a Roth. So what happened is people would then say, okay, I'll contact the plan, I'll take all my Roth account out of my 401k, roll it into my individual IRA to therefore defer taking payments out. So the Congress said, okay, we don't need to do all that paperwork anymore. Beginning next year, you don't have to take out required minimum distributions. Of course, the plan has to be amended to provide for that, but presumably they will. So that gives you a little bit more flexibility with your Roth. Now this, I'm not going to go into details, but simple IRAs and SEP IRAs, they're now, beginning this year, they're going to allow Roth contributions to those plans. And beginning now also, they're going to, for 401k plans, they're going to allow employers to make Roth contributions to your plan, either matching or non-matching. Now, the reason for this is they want to encourage the Roth because even though it grows income tax deferred, there's no upfront deduction. So this is how Congress is paying for the delayed IRA distribution. they're increasing the incentives to do Roth contributions to 401ks, Roth contributions to simple and SEPs. So the income taxes are paid currently on the contribution, and it grows tax deferred, but that's a problem for a Congress in the future, not now. So that's the goal of a lot of these next changes. Now, here's an interesting one that, again, will help people who set up 529 plans for their children or grandchildren. You set one up, you let it grow. As you know, a 529 plan, you can put money aside, income tax deferred, into a 529 plan. Ohio, most states, I think all states have them, or you can deal with the Vanguards of the world or Fidelities. They'll have 529 plans. The money grows tax deferred, and then when your child or grandchild goes to college, you can use this money to pay for tuition and books and other things, or room and board, and that's income tax free if it's used for the proper purposes. What happens is some people put so much money in their in the 529 plans. Maybe by the time their child or grandchild graduates college, maybe they had some scholarships, and so they didn't use all the money. So they had all this extra money in the 529 plan. So if they emptied it out at that point, they'd pay income taxes on the deferred growth, and they'd also pay a penalty tax. So this new rule, which kicks in 2024, allows some of the 529 plan to be converted to a Roth. Now, there are a lot of different rules on this, a lot of restrictions. Number one, the 529 plan must have existed for 15 years. So you have to start it early, or you have to keep it a long while. And that's okay, because if you're thinking about setting up a 529 plan for a child or grandchild, the benefit is the tax-free growth. So if you wait till a year or two before they go to college, it's very little benefit, very little tax-free growth. Ohio gives you a small income tax deduction, not enough to write home about. So if you're going to do a 529 plan, you want to do it early anyway. Then they won't include the last 5 years' contributions or earnings in this ability to convert it to a Roth. What they didn't want to do is have people start saying, hey, I'm going to take advantage of this. I know I don't need the money, but I'm start stuffing a lot of money in a 529 plan. Even they've had it for 15 years, but then they're right before they're going to convert it to a Roth, they start stuffing more money into it to take advantage of this. So you can't do that. Only the beneficiary of the 529 plan can take advantage of this, the child or grandchild, or wherever you change it to. Now, what I haven't had a chance to research, and I don't think it's prohibited, mom and dad set this up for their kid. I'm not sure they can't just make themselves the beneficiary of the 529 plan and make it their own Roth, but that'll be maybe a little bit more guidance from the IRS on that. But let's say it's for your child or grandchild, you can then convert this, or a portion of it, to a Roth. Now it's capped of $35,000 for the beneficiary. Again, brings up the question. So you name beneficiary 1. After you use up to $35,000, you change your beneficiary, your 529 plan, to somebody else. I don't think that's prohibited. Or you split that 529 plan maybe into a couple. But the maximum amount per beneficiary's lifetime is $35,000. And the annual amount you can convert is subject to the Roth limit. So, for example, if the Roth limit is $6,000 in a particular year, and that child has already contributed $6,000 that year, then they can't do anything. But if they contributed, let's say $4,000, then you could convert $2,000. So there are all sorts of restrictions. But the point is, if you have a 529 plan already, and maybe you figure, hey, I've got all this extra money, I'm not using it, hold off a couple years. Then you can use it to convert some of this to a Roth. It might be a good deal for your child or grandchild, because if they're graduating college and you're able to move $35,000 over several years into a Roth for them, that'll be a great benefit for them down the road. I don't know if you have questions. I don't see any hands raised, and I don't seem to be able to see this, unfortunately, this other part where you're allowed to ask questions. For some reason, I don't see it here. I'm looking again.
Mike?
Yes?
Lori, I'm looking at the attendees list, and if they have a question and raise their hand, it will show up in that list, so I can let you know.
Oh, okay. Okay, thank you very much. Let me go on then. So contributions, how much money you can stick in these things. Now, the only advantage of getting older, I figured out so far, is that as you get older, you get to put a little bit extra money in a Roth IRA, or a traditional IRA for that matter. That amount right now is $1,000. It'll be indexed for inflation beginning next year. So next year it'll be whatever inflation is over this next year, It'll increase each year like a lot of the tax code provisions. That's number one. So that's a benefit. Now they've added the catch-up contributions. They've done this thing beginning in 2025. If you're in the age group between 60 and 63, you get an increased catch-up contribution. It gets real complicated. Bottom line is, it's the greater of $10,000 or 150% of the regular rate. So in my example, towards the bottom of this first paragraph, in 2022, the regular catch-up contribution for a 401k is $6,500. So based on my math, it would be the greater of 10,000 or 150% of 6,500. So right now that's 9,750. So you can contribute 10,000. Bottom line, it's a little window that gives people between 60 and 63 a little extra money they can put in. Now, I don't know where they came up with those ages, but that's what they did. And then in 2024, they've also said anyone who has a salary from the employer plan, let's say you're in a 401k, if your salary is more than 145,000, any of the catch-up contributions have to be Roth. They can't be a pre-tax IRA type contribution, 401k contribution. Again, the purpose of that is they want to raise some tax revenue. Because they're giving some of these benefits that are reducing income taxes. So I guess their mathematics worked out that beginning next year, they want to start having people take advantage of this, where they can make catch-up contributions. But if they have a high income, it's got to be Roth contributions, means no upfront deduction. They still pay the income tax. They get a benefit down the road, tax-free growth, still a good deal. But again, the tax revenue issue that'll pop up will be down the road for some other people to worry about, not you or me. Another slight benefit that employers might do, as you know, if you have children have gone through college recently or are doing that right now, no matter how much you save for college, it's never enough. It just keeps going up year after year after year. So what they've done is, kids graduate from college, they have some pretty significant debt liabilities. And so there are many 401k plans have a matching feature, or a SEP or a simple plan might have a matching feature. You put in, $1,000, the employer will match it up to a certain percentage. Well, a lot of these young people, because they're graduating college with a lot of debt, they just can't afford to put anything in the 401k. And they're losing a great benefit. They're losing this match. It's free money, but they just don't have the money. So beginning next year, Congress said, look, if you can, employer, if you want, you can treat a payment that the employee makes to pay down their student loan, you can match that with a contribution to the 401k plans. They're treating, the employer's allowed to treat them as if they contributed to the plan for purposes of matching. It benefits obviously the young student, recent graduate who can start participating in a 401k plan a lot earlier if they're bound by student loan. So that's up to the employer whether they want to be that generous. ABLE accounts. Now, this was passed a number of years ago. You can set up these tax-free, tax-deferred, but eventually tax-free accounts for disabled children. It's through each state. Ohio has one also. And Lori Steiner, you've heard on the phone, she works a lot with people who do estate planning for disabled children. It's a great way to set aside some money to help pay some of the expenses of a disabled child without ruining their abilities to qualify for certain government programs. But it was pretty restrictive. The child had to be disabled prior to age 26. Beginning in 2026, again, I have no idea why they've kicked it over that far. The disability age now is extended to age 46. So if someone becomes disabled as defined in the rules, physically, or I should say probably mentally disadvantaged, if they become disabled prior to age 46, they can set up an ABLE account. Now, just to clarify, it doesn't mean they could be, older than 46 by age 2026. It just means they became disabled under age 46. So let's say they're 45 right now, and they become disabled. Well, by the time 2026 rolls around, that's 3 years from now, they're 48. They would still qualify because they were under age 46 when they became disabled. So it's just some future planning that you can possibly do. Now, there's some other changes to employer plans I'll mention in passing. This is, just some incentives to try to for employers to set up plans. If you have less than 100 employees, there's an increase the amount of tax credit you get off the business taxes for some of the administrative expenses to set up a retirement plan. It's not a big deal, but it's something. Beginning next year, they've expanded the simple plan. This is basically it's an IRA, but employers can set it up where they contribute money to the plan. They don't have all the paperwork of a regular qualified 401k plan. So there's a simple 401k plan. They allow you to do matching and non-elective contributions. They've just increased everything and make it a little bit better plan for employers who want to set something up, but they don't want to set up what is called a 401a plan, a qualified plan. This way, the money's put in an IRA for the employee. They're done. The employer has no other responsibility. The employee manages their own investments, and they're done with all that paperwork. So for many employers, that's a good thing to do. It's a good way to set up a plan without incurring a lot of expenses. Again, this gets real convoluted and complicated, but you can replace your simple IRA with certain 401k, simple 401k plans or other 401k plans. It just gives some more flexibility for employers if they want to get rid of their existing simple IRA plan. I'm not going to go into the details of that. Again, this is one that probably will impact no one in the audience, but I'll mention it anyway, is ESOPs, employee stock ownership plans. S corporations can have ESOPs, but they had some advantage. They lost some of the advantages of the other type of corporation out there called a C corporation. And now they're going to, beginning in 2028, so it's still down the road, you can do some special things with ESOPs even as an S corporation. So again, it's just in passing, nothing to do with that right now. Now that's just my reference, where I got all these articles from, or some of the research tools I used. So a couple things. We're going to send this outline out to everyone who attended, and also I did the seminar on the Secure Act 2.0 a year or so ago. If you're interested in that outline, please email Debbie, the person who invited you to the seminar, or email me, and we'll send you that outline also, just to give you the background of the 2020 law. And with that in mind, if anyone has any questions, please feel free to ask them. Otherwise, thank you for attending. We're doing a seminar. Lori, when's yours coming up? You have one coming up, don't you? Oops, I guess she's gone.
Next Tuesday.
Next Tuesday. And what's your
on ways to pay for long-term care.
Okay, so please look for that email if you haven't seen it already and sign up for that. And then we have others coming up. Jennifer Peck's doing one coming up soon also. I don't remember when, but I know it's coming up. So
hers is the following month. Hers is in March, and then you're speaking again. She's talking about the most important estate planning documents that you need to have in March on a Tuesday. And then you're speaking again in April on bloodline trusts.
Okay, great. Okay, thank you very much. And eventually we might even try to experiment again with in-person seminars, but we've waited on that a little bit. So I'll hang around if there are any questions. If not, you can always email me your questions or give me a call later. Thank you very much for attending.
I'm checking, Mike, and I don't see any so far.
Yeah. Well, next time you're in the office, you're going to show me where that hand. I didn't see it here.
I don't know. We have to figure out how your screen is set up. It's at the top of mine. It's really easy.
Ask me a question. Let me see if it pops up.
There is a question in the Q&A.
There is.
So this is the question from Michelle. My
Okay.
mother and I are both self-employed and both have Roth IRAs. Will we have to take RMDs?
No. You never have to take RMDs for your Roth at all, ever. Your Roth. If you inherit a Roth, you're going to start taking RMDs out.
So if anybody has a question, put in the Q&A, since I can see it and I can relate
Yeah,
it to Mike.
I don't know why I can't, but I don't see the Q&A. I'm looking. I think next time I'll use the chat box because I can see that.
We'll talk about that after.
Okay.
Okay, people have been logging off, so if anybody else has anything else, put it in Q&A or put up your hand as a raised hand and we will try to unmute you. All right, last call. Otherwise, we'll end the meeting, and it, however, is being recorded and will likely end up on our, or it's supposed to end up on our Solomon, Steiner and Peck YouTube channel.
Thank you all for attending. We'll see you next time. Bye-bye.